Hi, I'm Emma. Welcome to this video from OptionsBee.com. Today, I am joined by Kevin, our investment professional who will reveal to you the top 5 strategies to kickstart your trading career. Without further ado, I will let Kevin take over from this point onwards.
Hi everyone, I'm Kevin, and in this video I will reveal to you the top 5 strategies that professional investors are going to hate the idea of you knowing. To begin with, I'm going to show you guys how to read an open, high, low, close chart. The close is also known as the price the asset finished at, and this is always indicated by a bar going to the right. The open point is the price the asset started at, and this is indicated by a bar going to the left. As you can see from the graph, the high point in any of these bars is the point at the top of the bar, which demonstrates the highest price a share has reached over this period. The low point is at the bottom of the bar and is the lowest price the asset reached during this time period. The first strategy you are going to learn is the 3 consecutive bar trend. Basically, this involves looking for 3 bars which follow a specific trend. It can either be 3 bars going upwards, which indicates an upward trend, or 3 bars going downwards, which indicates a downward trend. If it is an upward trend, you call, and you put if it is a downward trend. In life, it is important to find what works for you and not necessarily follow the pack. The second strategy is known as ABC trading, which is all about being able to analyze specific patterns in graphs in order to make money. Here is a situation where you can spot an asset which is going upwards. You want to look for an initial long line going upwards. This is the A to B. You then want to look for a short decline. This is known as the B to C. This indicates that once the stock starts moving upwards again, it is likely to stay going upwards for a significant amount of time, therefore showing you should call on this asset. You would, of course, look for the opposite before deciding to put, as indicated here. Here is an indication of what this trend would look like on a graph. You can see the A, B, and C points creating the shape we are looking for. You will learn how this shape can also fail at different points later on in the video. For an upward trend, this shape tends to repeat over time, with each new B point being higher than the last. However, once a new B point is lower than the previous one, this is an indication that the trend has finished, and so should not be followed anymore. Similarly, if you note that a new C point is lower than the previous, then this is also an indication that the trend has ended. This would again be the opposite if you are following a trend which is indicating that you should put. The more you learn, the more there is for you to gain. The third strategy you are going to learn is known as technical analysis. To understand how to do this, you need to firstly take into account the historical price of an asset. Then you must make a note of the highest and lowest points this asset reached, and finally you must calculate the median price points. There are 3 different trend types: upward trend, downward trend, and horizontal trend. A long-term trend is considered any trend which has lasted over a year. A medium-term trend is one which has lasted between 1 to 3 months. And finally, a short-term trend is less than a month. Work until you no longer need to introduce yourself. The fourth strategy is known as fundamental analysis. The key to getting this strategy right is being able to get hold of market-moving data from countries such as the US, Great Britain, and Japan. There are 5 key factors you have to look out for. Firstly, the likely future earnings of the particular company you are looking at. It is useful to look at the earnings the company has per share. Secondly, look at their profit margin by comparing their costs to their revenue. The greater the gap, the bigger their profit margin is, which can be considered a measure of success. The formula for finding this profit margin is taking a company's net profit and dividing it by their revenue. The next factor you should look at is the return on equity to see how a company is performing for its investors. The formula for this is simply looking at their net income and dividing it by the shareholders' equity. Here is a quick comparison of the return on equity for two companies. As we can see, Company A has much less equity for the same amount of net profit, so gives much bigger return on equity to its investors. This is an important indicator for several reasons, as it gives us a clue regarding how leveraged a company is, the revenue it generates, and the return a shareholder gets. In this big world, it is up to you to choose the best path for your life. The fourth factor you need to keep in mind is the PE ratio, which is simply a calculation that shows you how much profit you get from a company for every dollar that you invest. Below is an explanation of how you can calculate this ratio. The PE ratio is calculated as follows: market price of the share divided by earnings per share. So, what's the whole point of this ratio? Well, it basically shows us whether a stock is overpriced or underpriced. If a sector is overpriced, we could see a shift in the opposite direction soon, and vice versa. Also, with respect to investment, you do not want to invest in a stock that's overpriced, so it is useful for this purpose too. This ratio is also helpful when we need to compare two companies. As you can see from company A and B, a lower PE ratio means you can expect higher earnings per share. In addition to all this, we can use the PE ratio to establish whether the stock price of an asset is likely to go up or down. This is useful for binary options trading when you need to determine whether an asset is going to increase or decrease in value. A high PE ratio indicates that a stock's price is likely to increase, as investors are willing to pay more for an initially lower return, as they expect higher returns in the future. A low PE ratio, on the other hand, indicates that investors are not willing to pay a higher amount compared to their returns, as they do not anticipate high earnings growth. Get the time to explore adventures that otherwise may have been impossible. Here's another ratio calculation for you to note down. The price-to-book ratio will help you to establish whether the price of a stock is overpriced. A price-to-book ratio that's higher than 1 suggests that a company's stock price is higher than what the company's assets would be sold for. In other words, you can argue that a company with a price-to-book ratio of greater than 1 is overvalued. However, a price-to-book ratio of less than 1 implies the stock of a company is undervalued. The fifth and final strategy is known as boundary strategy. This strategy involves predicting whether the price of an asset will remain between two set points. Here are the 3 easy steps to help you establish the average price of a specific asset. This can then be used to help you determine whether the price of this asset will likely remain within the 2 set points or go outside these 2 set points. The out strategy basically involves you predicting whether the price of the asset will break out of the set boundaries. Using these simple strategies which you have learned today, you can slowly start to take more control of your life and develop a lifestyle that's more fulfilling for you and your family.
Thanks, Kevin, for your invaluable strategies today. Click the button below to check out all the free educational content available at optionsbee.com, the #1 online trading guide. Thanks for watching. Options Bee wishes you a successful trading day.